Welcome back. John Maher. I am the Chief Investment Officer at CCR Wealth Management. Our last video, we introduced the concept of behavioral finance, sometimes called behavioral economics, but we did so by discussing actual return informations for individual investors tracked over the long term through mutual fund inflows and outflows, mutual fund and ETF inflows and outflows. A long-term rate of return, 2.9%. Now that's up somewhat from 2.1% 4 or 5 years ago, but it still doesn't keep pace with inflation, certainly not in today's environment. And it greatly underperforms the track record of most major asset indexes and certainly asset allocations made up of those indexes. So recall that in reviewing fund flows, we pretty much discerned, and we maybe put the microscope of the last 5 years, that investors are generally in the habit of buying high and selling low. And if you know anything about investing, it's tough to make money doing that. Dalbar, the market research firm that puts out this study, has identified psychological factors as the #1 culprit in assigning blame to kind of why is there this big disparity between what investors actually earn and what the market actually does. We've actually encountered more and more asset managers, and by that I mean mutual fund companies with whom we work are addressing behavioral finance issues. Really, they're trying, I think, to bring some rudimentary education to advisors, but more an attempt to add value than it is to, be able to provide a solution to it. Because as we've discussed and we'll discuss again, solutions are elusive. But what it is an admission of the prevalence of the issue, right? You can put yourself in the best investment vehicles in the world, and chances are what the Dalbar study says is that investors are going to muck it up themselves, despite the fact that they're in optimal investment vehicles. So, a quick history of behavioral finance. It's not particularly a new concept. Some of the nomenclature is new. But for the last 100 years, I think investors have, or people in general have assumed that there's got to be some kind of a connection between how we think and in your investment results, right? Because there's a big disparity between investment results between different people. This is underscored by the fact that in 1912, there's a book written called The Psychology of the Stock Market by someone named G.C. Selden. But it was a few decades later with a guy by the name of Leon Festinger, produced a study on cognitive dissonance, and it was mid-1950s. And cognitive dissonance is a term and a concept that meld nicely into the modern list of some of the cognitive biases we'll discuss later. And we're going to touch on this maybe in the next video. 64. An economist and a Harvard statistician at Harvard University explored something called the utility of money, utility of wealth. And we talked about, we're going to be talking about the utility function itself. He was also a pioneer thinker on risk aversion. So both the utility function, risk aversion play heavily in today's thinking on emotional biases, on loss aversion, which is an emotional bias, and explains, or at least gives the background under kind of the foundation of why so much irrational decision-making is made. We'll talk about that in the future. Modern behavioral finance, the discipline of figuring out why investors do what they do, largely congealed during the 1980s into the 1990s. And since then has had many contributors. Among the most influential are Richard Thaler, Daniel Kahneman, and Amos Tversky. The latter two actually worked together. They were cognitive psychologists, and Richard Thaler, an economist and finance theorist, adopted much of their work into what would become known as behavioral finance today. The premise of behavioral finance is simple. So much of what we know about investing and about portfolio management, security selection, finance in general, is predicated on this concept of rational economic man, or REM. MPT stats, utility theory, efficient frontiers, Bayes formula. I could go much deeper and start getting into valuation formulas, but I'll stop there. I mean, these are all concepts which explain, or at least help us think about the very complex nature of asset classes and of individual securities and how best to manage them to achieve optimal investment results. These fall into the umbrella of traditional finance. I want to underline that term, traditional finance. Concepts, they're grounded in neoclassical economic theory. Traditional finance is prescriptive. What we mean by that is that traditional finance lays out to investors what they should do. But it assumes a lot. It assumes much of us. Some of the assumptions of traditional finance are the following. It assumes investors are rational. It assumes investors are risk averse. It assumes that we have perfect information. And think about that for a minute. With all the info, I don't think people today have ever had more information at their fingertips, but hardly any of it is perfect. It also assumes investors are self-interested, and it also assumes that investors seek to maximize the utility of money. We're back to that utility concept again. So let's give a quick definition. Utility, in economic terms, utility is the value we place on more money. How much value do you place on more wealth? Two homes, generally, a lot of people can agree, maybe most people can agree, two homes are better than one home. If you got a vacation home and your primary residence, that is economically better off than simply having one home. But as you go up the utility scale, it becomes more and more questionable. What about 7 homes as opposed to 6? How much better off are you with 7 homes relative to 6, or 10 homes relative to 9? So you get where I'm going. Utility theory is enlightening when we get into something else we're going to talk about later on called prospect theory. But here's the problem. You know, the first assumption of traditional finance is that investors are rational. Investors are not rational. In addition to calculating and understanding MPT statistics and efficient frontiers and using Bayes formula, I mean, this requires quite a bit of math, quite a bit of algebra, in some cases, quite a bit of calculus. Standard deviation, correlations, covariances, required rates of return, the capital asset pricing model, et cetera. Even understanding a balance sheet or an income statement, for most investors, those are elusive concepts. So human beings are obviously not computers. Rational economic man doesn't actually exist. Instead, we know from the works, particularly of Kahneman and Tversky, highlighted in a book Daniel Kahneman wrote called Thinking Fast and Slow. I recommend it highly. That investors are actually loss averse. That differs from being risk averse, and we're going to discuss that later. Investors overestimate the likelihood of low probability outcomes. Investors have informational limitations. It involves how well we understand what we're absorbing. Intellectual limitations. In the last video, I talked about, for example, some of us may be more mathematical oriented versus some of us may be more critical thinkers versus others. This falls under intellectual limitations, cognitive limitations, and rather than seeking to optimize all investment decisions, we operate in a world of bounded rationality. In our world of bounded rationality, we take mental shortcuts. That's what we do. I mean, we estimate, and we estimate imperfectly rather than calculate. We rely quite a bit on our own personal experience. Mental shortcuts, estimations, personal experience. Simon refers to this as heuristics. And we'll probably use that term more than once as we go forward, but heuristics is this process of mental shortcuts. In some cases that can be useful. In some cases it can help us process information quicker and harmlessly. But in other cases, heuristics are really kind of the open door to our own self-harm behaviorally when it comes to investing. So in summary, traditional finance provides the path to what investors should do. Behavioral finance studies what investors actually do. And much of what investors actually do lead to long-term rates of return of 2.9%. And that's the focus of these videos. The heuristic methods people employ to manage their finances lead to some very common traits, common amongst all of us, and I do include myself in that, which we call behavioral biases. Letting these biases run amok, control our investment actions is what tends to lead to suboptimal returns. So there's two basic categories of biases in individual investors under the behavioral finance umbrella. The first is cognitive biases, and the second one is emotional biases. So the next videos are going to dissect these two categories, cognitive biases, emotional biases, and we will also take it a step further under each umbrella and list out some very specific, and as I said at the beginning, very common biases, which I and many financial advisors repeatedly encounter. So we hope you stay tuned. We hope you find it informative. Thank you.